Thank you very much, Marty, for having us. And today we're going to do something that's a little old school. We have some show and tell for you. Today we brought one of our portfolio companies CEO, Anshu, who's with me to tell a little bit about his company. But before that, I want to give some construct to what Marty just presented, and that is, is there opportunity still to, particularly on the long side, because we run a long short fund. As you can see, we've been able to capture the majority of the upside of this market upswing, and pretty conservatively miss the several pullbacks that have happened over the past 8-9 years. And how we've done that are both with the traditional long short tools. We're generally net neutral right now. The market's pulled back about 24% in the tech market, maybe the aggressive tech market a bit more. Net as of the end of actually May, we're down about 6. So how are we, doing that, but also capturing a lot of the return? And that is generally we take a GARP type of strategy, very traditional. I've done this for a long time, since 1986, and that is kind of the foundation of our investment style. We don't pay growth at any price. We really pay attention to valuations. And so as valuations got peaked out, we have been generally short, but also now net short. And we also use convertible debt, which has been a big thesis amongst a lot of the speakers. And that convertible debt also has that asymmetrical type of return. Obviously, you get the bond type of base return. Our yields are generally 15 to 20%. And then you're going to capture the equity upside, particularly if you're in a good growth area. And I'll go into 2 good examples of deals we're funding right now within the context of the fund. And you'll also hear a little bit about more of the fundamentals that the company that Anshu runs called MPhase that we've also recently funded. And but with that said, I'll before we jump into how they're doing and what exciting stuff they have going on, I'll review one of the company that has been a core holding of ours, and we just are adding more to right now, and that's called Biotricity. All of our companies are kind of in the ESG domain. We stick away from oil. We stick towards friendly opportunities, usually in med tech, green tech, fintech, and Biotricity has been one of those that has performed it's in the remote care and money saving side of medical. And they've done great. Since we first came and allocated to them, they were small. They were public, but they were $100,000 in revenue. And they just now per quarter reached $1 million per month. So they've not only just gone at 10x per quarter, but they've actually gone per month now at $1 million. So what opportunities that we do in kind of an activist strategy, but also a tough time in tech, because tech has definitely pulled back, to say the least, as we look towards providing some debt to these companies where we know we can have impact in kind of an activist way. And so in their case, we're putting out $2 million to them in a 15% yield instrument with some equity kicker on top of that, about 5%. And that $2 million, just to give you the simple math, should produce about $20 million of new revenue for them. So very cause and effect, very impact oriented. And very fundamentally kind of powerful for a small company who's doing about $10 million of revenue. Now they're at the point where you can give them money, give them a dollar and they produce $10 of revenue. And in a tougher time, that dynamic is pretty important, right? It is a very difficult time to be waiting on something like an FDA approval. We're looking for companies in the context of our fund, particularly when we lend to them, that you can actually allocate to them and they're able to turn that into immediate revenue with immediate customer and immediate impact, right? So that's generally how we look for companies to kind of protect our investors' downside and our fund's downside, but still get that equity upside potential. And with that said, I'm just going to frame up MPhase for you real quick, because it is in the EV space and is very much so one where you can give $1 to an investment and they can produce $10 of revenue. But it has all the characteristics that we look for in terms of The valuation was extremely competitive. They're at a 0.3 enterprise value to sales. The peer group's trading at 20 on average. So there's massive equity upside, to say the least. They actually are one of the only profitable companies in their sector, which is great to be profitable right now. And they have some of the highest margins in the sector and some of the highest growth because they have a cloud first strategy, which you'll get into in a moment. But from what we're looking for in terms of providing capital, we also used a convertible debt structure, again, protecting the downside, but offering that upside. They really had quite a bit of attribute that we're after. Plus, in the near term, the wind's really been at the EV sector's back, right? As gas has gone up now to 120, which is pretty amazing. I wouldn't have bet we'd see such a high price. Of course, demand for EV chargers and EV in general continues to scale up with that. So all in all, for the factors that we were looking for, they had the potential, more potential than actually any company I've ever allocated capital to, from that perspective of all the positives were there, good macro, uplisting to NASDAQ. They've filed an S1 and they're getting actually uplisting, so they'll become liquid and institutionally viable. They have scalability. Their revenue is 32.8 million as of last quarter, trailing 12 months. At 10 times sales, that's 320 million market cap. That gets to be in the realm. Your institution started about $250 million. And basically, I could approach that with structure. So all those things led up to, for us, something that was really compelling. But what I've never had is a valuation disparity this big. Usually, we're getting about a 50% discount consistently when we get into small cap, but we have something we can institutionalize. In this case, it was a 1/100th valuation gap. So it was really exceptional. But most importantly, and I wanted to then hand it over to Anshu, the company now is blossoming with some major brands. They just won 19 national brands with their platform in the past month on their EV chargers, which goes to, so it's not us speaking to it. They have brands like McDonald's, Subway, and many more now backing their solution. And I'd like to have Anshu just give you a quick update on why they're coming to him and how he thinks he can continue to ramp the company. So I'm going to shift gears and let him introduce the company fundamentally and tell the story. Anshu, please.
Thank you, Chet, and Marty, thank you for the opportunity. A quick background, I mean, MPhase Technologies, we're basically a technology company first, and an EV charging that provides a EV charging solution. We feel that the industry is definitely shifting. Just about every automaker is now going to be making an electric vehicle, and the way people, quote, fuel up is not going to be the same. You know, we're not going to be fueling up en route to a destination. We'll either fuel our vehicle at destination, or where we fuel up will matter. If I have to sit an hour or 45 minutes at a place, it matters where I'm sitting. And there's a huge opportunity there to basically engage that customer and to be able to monetize and make, money on that sort of transaction beyond just the fueling. And that leads to a happy customer and also a happy retailer. No one else in the space is currently doing this. Most people who we sort of compete against are really infrastructure first. They're kind of replacing the gas station model. They're building another gas station. We're looking at this, really, we came at it from a technology cloud first approach, where we were really in the consumer engagement standpoint, and then we are now driving traffic to retail locations through our charging platform. Just to give you a little history on how we got here and why we're so well suited for this. The company's been around for a long time, since the late 70s. It's been a spinoff of Bell Labs, where we were predominantly focused on nanotechnology and battery technology. So in a way, you can say battery technology is in our DNA. 2019, I was hired as CEO to help monetize our patent portfolio and make the company from an R&D focus to actually start generating revenue. I did a series of acquisitions when I took over. The first company we acquired was really a platform called Travel Buddy. And the purpose there was really to bring on a strong AI and machine learning team. And these are some of the smartest guys in the industry. So we acquired them for that purpose. Turned out that they had a phenomenal platform to essentially create trips dynamically. We then acquired a company called Alpha Predictions, where we brought on our own data analytics team, as well as some key technologies like our recommendation engine, the sentiment analysis engine, and a couple other key technologies. And finally, we acquired a company called Closecomms, which brought in our consumer engagement platform. And this platform that we acquired, which was 2132, was a fully vetted system. We had an 18-month pilot with Subway, and Subway, as you know, is the largest QSR and retail restaurant in the world in terms of number of locations. That led to a corporate account with Subway. We also had pilots running, or still have pilots running, with McDonald's and Burger King. We signed a corporate account with Nathan's, and we signed a corporate account with NCR, which is one of the largest points of sale systems. And with that, we were rolling out into Chipotle, Panera Bread, and the likes. And that's around when COVID hit, and restaurants were all shut down initially and had to kind of re-look at how to engage their customer base. It was around that time we were approached by an EV charging company to see if we can help build a EV charging platform, because they recognized we had all the right components. We had a Waze-like mapping system through our travel platform. We had our recommendation engine and analytical engine, and we had a engagement engine with 2132. We pitched this to our customers, and they absolutely loved it. And they were all looking at a way to, maybe look at putting EV charging in their parking lots, but that whole value proposition of putting in chargers didn't necessarily make sense. But if I can drive sales, that was something that made sense, and they could cater towards that green customer. So we spent the last better half of last year building out our EV charging platform, which is probably one of the most advanced in the industry today. We are bringing on, and as we pitch this to more of our customers, we have now well over 10,000 retail locations in our pipeline that we're rolling out right now. And again, what we do is we are cloud first. So we come in with our consumer engagement platform first, and then we bring on the charging sort of after the fact, which allows us to make revenue and be profitable even prior to utilization of EV charging happening. So in that regard, we are probably the second, and at least in the public markets, we're probably the second largest in terms of revenue, and we're probably the only profitable EV charging company that's there with a clear visibility on future profitability. Yes.
How do you pick these retailers? Is it based on the amount of time people spend dining out, or is it based on how large they are?
Yeah. So we look at of course traffic and all that matters, but the way we kind of look at this is we don't need to look at EV density as much as some of our competitors do, because we make our revenue on the engagement. So as long as there's good retail brands, Subway, McDonald's, restaurants, gas stations, hotels, there's a market for our product, and there's a market to engage our customer. And so even though our initial rollout is centered around large brands such as the ones I mentioned, it's how I can engage those customers and drive traffic to those retail locations.
So, I'm sorry, what do you mean you make money from engagement?
So I'll give you a perfect case study, right? So we have, I drive an electric vehicle, a Tesla, and they're one of the few companies that own the entire ecosystem, right? They own the charger, they own the in-dash entertainment, the engagement, they own the consumer. If I'm driving from point A to point B, and this happens to me all the time, it tells me I need to refuel at a charge at a particular location. I'm not sure what's there. It just says, hey, you need to recharge. You'll have 6% battery left when you enter a particular location. I get there. it's a restaurant that hasn't opened yet. I pull in the back, I fuel up, I have no place to go to the bathroom, I have no place to get a cup of coffee. If it's midnight, just imagine, and it's late and you're a female, I could go for a little hike in the woods, but someone else might not be able to, right? What we would do is we would say, hey, instead of stopping at this 200-mile mark, why don't you stop at the 175-mile mark? There's a Dunkin' Donuts there. You say, oh, great, I love Dunkin' Donuts. Now I can load your digital wallet with coupons. You go there, your food is ready, you're a happy consumer, and Dunkin' Donuts gets a sale that they wouldn't normally have. So that's kind of our sort of value proposition. We get paid.
Is there a charge for charging up?
Yes, we charge on for charging up, but we also, from our standpoint, we also get paid by the retailer itself. We get a per location per month fee. Plus, we have additional ways to monetize in terms of the sale. Exactly. So as a result, we're able to make sort of revenue across the board.
And all these stations are the same as the Tesla charging station?
We have both the level 2s and the level 3s. Tesla, as you see, are the level 3s, the super fast chargers, but we find that a lot of locations don't require that. A level 2 would suffice. So for instance, a hotel, you don't need to supercharge if you're overnight parking. If you're going to a steakhouse, you might just want to plug in and refuel while you have dinner. Same with a grocery store. And where other places require super fast, our highway locations, we partnered with Ford. We're dealing with some Ford dealers, and they're all superchargers. Yes.
So I don't know if an electric vehicle. Sorry.
No.
Sort of like the iPhone, you have the Lightning, and then you have the USB 2 and 3. What's it like when you go up to like going to the Kennedy Airport to like charge your phone?
Yeah, good question.
Or maybe a Lyft driver, you know, in the backseat.
Yeah. So it used to be at this point, there's only two charging formats. One is Tesla and one is everyone else. And even the everyone else, you can just have, there's typically an adapter, you can charge a Tesla, but at Tesla stations, you can only charge Teslas right now. Yep. And the other sort of positive is just from an industry perspective. I mean, there's a lot of money being poured in from the government in the infrastructure bill when it comes to charging, right? And that's kind of where we feel we could make tremendous. Just, I mean, the charges are in most states we can get 100% paid by the government, and then we make a recurring fee per location or per charger per month. On the chargers, we make an engagement fee on a per location per month, which is tremendous.
So at some point, density does play into this, right? I mean, you have more people using your services, say, in San Francisco.
Yeah, absolutely. But when we look at, so again, there's two sides of our sort of platform. One is the actual charging network itself. Like, hey, how many people are actually going to, how much revenue are we going to make from charging a vehicle? And the second is how much money do we make on quote advertising? So if you look at the closest competitor in terms of what we do is Volta. And if you look at Volta, if you ever been to a Whole Foods or a Safeway where they have those big 50-inch screens, those are Volta stations. They make their money on advertising. So they essentially give away charging for free. So they don't really care how much you make on the charging itself. They make money on digital advertising, but they're not advertising to you as a car owner. So they don't own the customer, right? So that's where the difference is. Yeah, but here what happens is in our case, we actually own the customer. So we have many other ways that we can continue to monetize that customer. Yep. And so there's tremendous other sort of opportunities here that we feel we have. Yeah. So we have a much.
Another question.
That's right.
So some phraseology, cloud forward or cloud first. That's because you just back to your MPhase.
Correct. And the fact that we start our engagement with the consumer engagement platform prior to even putting in chargers in the ground. So like for instance with Subway or with the likes, we're working on them on their platform prior to even, not all locations will have chargers. They could be some in strip malls or in actual malls, but they're still an engagement platform for companies like that. Yes.
What about hotels?
Yeah, that's a big market for us. We're rolling out every hotel. Like as a electric car owner, I would not stay at a hotel without a charger because that means I have to get up in. Yeah, yeah, it means I have to get up in the morning and have to look for a charging station. So more and more that's becoming a big deal for hotel owners, and we're working with not only the actual owners themselves, but also the yeah.
So you're almost like a white label
So not really, because the charger itself is pretty much a dumb charger, right? Where the value is on the network, right? So anybody can make the actual physical charger, but when it comes to which platform you're on, ChargePoint, Blink, it's all on the network that they're running. And so really our value is in our network and our software, and the charger itself is anybody can make that.
We got about 5 minutes. 6 minutes.
Yeah.
One more question.
Yeah.
So I noticed that you spent dollars on that. I am sure that I've done deals with.
Sorry, just to be clear, that the 210 million was not on the acquisitions. It was on the R&D from 1970s onwards that their company was doing in terms of the nanotechnology and battery tech. A lot of that stuff was with the U.S. Army and their missile defense and their yep. So yeah, just to be clear on that.
Acquiring companies. Innovation needs the tech stack, right? All the time that I personally have constantly swapped out of tech stacks because something looks good in year 1, 3 years later, they're archaic, they're swapped them out. Sometime in year 2. And paying that contract out to the end of year 3 because I don't care, I know I'm swapping them out. So from a tech stack perspective like that, tech stack like this graph, these graph paper needs lots of your tech stack has to innovate pretty much the 4 corners of your graph paper.
No, it just actually, incidentally, it just sort of worked out where when we acquired that travel platform, we weren't looking to get into the travel business, right? We acquired it for the engineers and the team. And it turned out that we had a brilliant, I mean, this was just absolutely, it's like a Waze-like system that was absolutely brilliant, right? And what they did was something that was amazing. These were all ex-McKinsey guys and, some of the smartest guys I know. And it's perfectly being used in a application that at that point, I wasn't thinking of getting into the EV space. It just worked out. So. Yeah, we keep innovating. So we are a technology company. So as we build our AI around our now charging network, we keep innovating. We're going to keep investing in R&D as we move forward. But we have as I mentioned, a clear visibility on rollout, our customers, our revenue, that we can manage that. It is, yes.
So just to thank you, just in summary, so again, what we saw that was quite special, other than all the many factors fundamentally that he described from a financial perspective, mechanically, the valuation tied to something that had scale, because the company's most recent quarter was about 8.3 million. You'll see this one be a little bit bigger, but the real growth is about to happen. And I think that there was a nice question about, cloud first revenue, what's that mean versus your peer group? Remember, the special thing is not only are the margins higher, the profit higher as the company rolls, but the growth is almost exponentially faster than the peer group because you're winning the cloud customer first, and then you're backtracking about 15% of EV pull-through. So that initial growth is not only higher margin and more profitable, it's quite a bit faster than the 4 or 5 other peers that like ChargePoint. They're growing on a very linear EV by EV basis. So with that said, we saw a lot of merit in the company from all degrees, and we appreciate you taking a moment just to hear the story.
So how do people invest in this? Is it a co-investment vehicle with you?
We do both. I mean, in our fund, the context, this deal will be more than we allocate. We have an investment banker, H.C. Wainwright, doing the uplist deal to NASDAQ. That's been filed. You'll see that in about 45 days. And we allocate on the private basis to do an uplist convert, and we'll allocate into the public registered offering as well. So some people like to do co-investment. That's something there will be ample room, in particularly in the uplist deal with H.C. Wainwright. And but with that said, even the private deals, there's usually co-invest opportunity, and there is here as well. So it depends on what investors want to do. Obviously, the fund itself is a way to get exposure to it, of course, right? But thank you all. And if there's no other questions.
And the stock split is a reverse stock split.
Well, so that to get up to NASDAQ, they'll get the stock up to $4. That's the only requirement that the company needed to meet. But on an enterprise value basis, the company is a small, $15 million, depending on the day, $20 million company. And basically, their only requirement that wasn't met was that.
So today it's OTC.
Yeah, it's OTC,
Yep.
and then post deal on the next day, it'll be NASDAQ.
And what's the timing on that?
About 45 days.
45 days.
Right. It'll get up to NASDAQ, and that's of course where the institutions can begin to look. And the unique thing about this is the revenue trailing 12 was about 32 million. The sector trades at about 20 times. So you can get this institutional scale quite readily. Right. So we're excited about this one. And again, when you talk about what are you doing today in today's market to make some capital gains, we certainly think that this one has all that potential upside.
I just have one more question for you, which is, what's the opportunity just in general? Like, as I said, there was this outflow from ESG. So it seems like a lot of the, investments are becoming crammed down. What do you, if you had to which way the wind is blowing sort of thing, Chet, in terms of ESG, what are your thoughts in terms where are there great opportunities, private, public?
At a higher level, the tech and ESG space has been coming down for 18 months, as you know, like the ARC Innovation Fund. And so you're probably, in my opinion, it's almost a duplicate match of the .com bust, right? You're probably about 2 or 3 months now away from that bottom. So we actually were short a lot of the ARC funds and their holdings for about the last year. We covered and are beginning to nibble. But I'm still really, as you say, it's going to be another tough month or 2 or 3, right? As the interest rates get clipped up. So we're still really emphasizing doing things like converts like this. But you're definitely seeing stuff now at 5-year lows, right? And that's where you begin. And so it's available, and we're picking away at it, still conservatively with debt, but some things like China, have made a solid bottom, right? And so there's I wouldn't be going long oil hard up here. I know Kramer says do it, but I'm not a big fan of that. I'd be thinking, well, what's at the opposite of the spectrum? And that is a lot of Greentech. It's a lot of the stuff that is deflated already. Right. So that's from our value perspective.
Sure. Yeah. And right. I think it's going to be a lot of, green fields for you, so to speak, in terms of investing. By the way, what you're doing isn't like a new sort of approach. I think it's just clever. And I'm saying it's not financially innovative, but it's a clever usage of some old tools that are out there to get true value, which I think a lot of things have untapped value in the market. But
absolutely, yeah.
Great job. Thanks so much, guys.
Thank you.